The ticker flashes again. You blink. The price jumps, dips, up, down, sideways. And your gut wants to panic. But stop. Stop right there. This isn't a mistake. This isn't chaos. Markets don't actually fear the headlines. The wars, the Fed, the inflation numbers. They don't flinch at what everyone is talking about. They flinch at what's hiding in plain sight. Look closer. Not at the $70 silver today. Not at the $2 drop yesterday. Look at the patterns nobody's mentioning. The way liquidity pools move. The shifts in positions before the news even hits the wires. That's where tension is real. That's what drives the sudden swings that make people spill their coffee, press sell, and curse themselves hours later. Most people think volatility is a signal of panic. Wrong. It's a reflection of blind spots. Not in the market, in you. You and everyone else watching the same numbers, reacting to the obvious. The market has already seen further, already priced it in, already moved on. So here's the question. Are you seeing what it saw yesterday? Or are you staring at the $70 number and pretending that's all there is? Because the story isn't on the chart, it's in the currents beneath it. Silver opened at $65.70 per ounce on Monday morning. By mid-afternoon, it touched $70.10, a swing of $4.40 within a single trading session. The daily range had widened sharply compared to last week, when prices oscillated within a $2 band. Over the past 7 days, silver has moved from $68.50 to $70.50 at its peak, then retraced to $66.25 before stabilizing around $69.80 at close. Gold showed even larger proportional swings, moving $45 up and down within the same period. These movements were accompanied by unusually high trading volumes on the COMEX and other bullion exchanges, with open interest in silver futures increasing by roughly 12% over the past 3 sessions. U.S. dollar strength also played a measurable role. The DXY index rose 0.7% on Monday, coinciding with the morning spike in metals. Typically, dollar appreciation puts downward pressure on gold and silver, but on this occasion, silver remained elevated, showing a divergence from historical inverse correlation patterns. Refiners and dealers reported near-immediate depletion of certain bullion products. 1-ounce rounds were sold out within hours at multiple large retail outlets, while graded silver eagles, MS69 and MS70, remained in limited quantities. Junk silver and constitutional coins were trading slightly below spot by $1 to $2, reflecting both scarcity and transactional premiums. On the geopolitical front, Iran-related developments in the Strait of Hormuz influenced oil prices, which in turn contributed to commodities volatility. Brent crude traded between $83 and $90 per barrel over the last 3 days, a narrower but significant range relative to the past month. Institutional buyers and central banks maintained steady demand, adding verified pressure to the market. According to the World Gold Council and published central bank purchase reports, net acquisitions for silver and gold continued at rates consistent with prior quarters, without dramatic deviation. In summary, the last week saw a combination of higher volatility, increased volume, rapid depletion of bullion inventory, and a temporary decoupling of traditional correlations between the U.S. dollar and precious metals. No forecasts are included in this section. All figures come from confirmed market data and historical trading reports. Silver isn't just a number on a screen. When it swings $4 to $5 in a day, there's more happening beneath the surface than traders reacting to the latest headline. Those 1-ounce rounds that vanished off the shelf? That's more than scarcity. It's capital flow, literally moving ounces from retail shelves into private vaults. Each transaction shifts inventory, alters supply chains, and affects pricing in nearby markets. First-order effects hit dealers and refiners immediately. Refineries process alloyed silver in rounds based on demand. When orders spike, supply gaps appear in hours. Dealers report that the same shipment received in the morning can be fully committed by afternoon. That impacts spot premiums. Graded silver eagles or proof coins may hold steady in price because supply is limited, while generics, rounds, junk silver, move closer to spot due to rapid turnover. Second-order effects ripple outward. Regional markets notice. Futures contracts adjust. Open interest grows. COMEX trading volume surges. Algorithms detect volatility. Some margin calls trigger. Those are mechanical reactions, not emotional. Even if nobody panics, the market machinery reacts as if someone did. Currency correlations matter here too. The DXY's rise usually pressures metals downward. This week, silver decoupled briefly. That means dollars are appreciating, yet metal prices remain elevated. The cause, demand outpacing conventional inverse correlations, likely from stacking and institutional buying. First order effect, bullion inventory tightens. Second order effect, spreads between spot and retail premiums widen slightly. Geopolitical tension compounds the picture. Iran-related developments, even minor, impact oil futures. Brent crude's $83 to $90 range affects inflation expectations. Inflation, in turn, nudges central banks and investors toward hedges. Gold, silver. First order, futures see spikes. Second order, retail stacks more aggressively. The feedback loop feeds volatility, but the root driver is real demand and scarcity, not speculation alone. Even at $69 to $70 an ounce, silver's historical context matters. 1 year ago, silver hovered around $30. That means, in confirmed terms, anyone stacking for wealth preservation has more than doubled their purchasing power in a year. First order effect, increased buyer confidence. Second order effect, higher transaction velocity, tighter supply, amplified short-term swings. Every movement, every spike is a system of cause and effect. Retail scarcity, refiner capacity, futures positioning, currency shifts, and oil-linked inflation expectations all interconnect. Ignoring one link misreads the picture. The market isn't panicking, it's simply adjusting to currents most investors never see. Currents beneath the daily headlines, moving in ways that set the stage for the next ripple. This section links data to real-world implications without judgment. Think back to 1980. Silver peaked near $50 an ounce following a period of steady accumulation and market stress. The price swings then, sharp daily jumps, high premiums for rounds versus government coins, look similar to what we've seen recently. Dealers recall shelves emptied within hours, premiums widening unexpectedly, and refineries running at capacity. The pattern of retail stacking responding to high volatility has precedent. Flash forward to 2011. Silver hit roughly $48 an ounce again. Volatility spiked. Futures volumes ballooned. Spot versus retail spreads widened. Investors who had been stacking quietly for months suddenly became active participants. Supply bottlenecks emerged not because of speculation alone, but because industrial demand, investor demand, and logistical limits intersected. Retail buyers faced empty trays, while refiners had to prioritize allocations. What's different this time? Several points. First, the absolute price is higher, around $70 an ounce. The premiums baked into graded coins are comparatively smaller than in 1980 or 2011. Second, the digital infrastructure for trading is far more advanced. Orders execute instantly, futures contracts are algorithmically monitored, and global connectivity means that flows adjust faster than in prior decades. Third, geopolitical drivers are more complex. In past peaks, inflation was mostly domestic. Now, currency moves, oil prices, and regional tensions interact with stacking behavior. Confirmed reports show that despite volatility, central bank purchases continue at a measured pace. Inventory records from bullion dealers and refineries confirm rapid depletion of small rounds and moderate supply of graded coins. These historical parallels demonstrate a recurring cycle. High demand, limited short-term supply, and volatility in the physical market. But each cycle differs in context. Price levels, geopolitical pressures, and technological infrastructure all vary. History is a filter, not a forecast. It tells us that when volumes spike and shelves empty, patterns repeat in terms of human and institutional behavior, but the outcomes are never identical. This perspective helps dampen emotional reactions to sudden swings and allows stacking decisions to be made based on structure and confirmed market behavior, rather than headline fear or speculation. Bull case: if industrial demand and retail stacking continue at current or higher rates, and if central bank purchases maintain momentum, silver could see sustained strength. COMEX and bullion dealers report that inventory depletion is real and ongoing. If new supply from refineries remains constrained, premiums for rounds may widen further. A continued or intensified geopolitical stress in oil-producing regions could reinforce the trend. Historical precedent from 1980 and 2011 shows that when demand outpaces short-term supply, prices can spike sharply in a compressed time window. If these conditions align, holders stacking at $69 to $70 may experience relative gains over the next months, though the magnitude and timing remain uncertain. Base case: if supply chains stabilize and new production or dealer restocks arrive at anticipated rates, silver may consolidate in the $68 to $72 range. Open interest on futures contracts is high, but not extreme, suggesting market liquidity can absorb daily swings without runaway price spikes. Historical data indicates that after a week of $4 to $5 swings, markets often settle into a narrower range as retail demand normalizes. Expert forecasts, such as those from the World Silver Survey 2026, forecast not a guaranteed outcome, anticipate moderate upward pressure from central bank and industrial demand, but do not suggest extreme volatility beyond current levels. In this scenario, stacking continues steadily, with premiums remaining moderate and market participants adjust without systemic disruption. Bear case: if refinery allocations increase faster than stacking demand, or if industrial demand softens unexpectedly, silver could retrace below $65. Historical comparisons, such as late 2011 to 2012, show that sudden relief in supply or slower retail uptake can produce multi-dollar daily declines, even when fundamentals remain broadly intact. If the US dollar strengthens sharply beyond current levels, this could mechanically pressure silver prices downward, compounding retracement. Additionally, if geopolitical tensions ease unexpectedly, reducing oil-driven hedging activity, short-term buyers might pause and volumes could thin. In this scenario, premiums compress, small rounds become more accessible, and daily swings moderate, but the medium-term supply-demand balance remains a critical watchpoint. Across all scenarios, the principle remains: silver does not move in isolation. First-order effects, retail demand, refinery capacity, central bank activity, interact with second-order effects like futures positioning, dollar strength, and industrial hedging. Conditional logic clarifies the stakes. If supply tightens or demand rises, then prices move upward. If supply relaxes or demand softens, then prices retrace. This structured probabilistic thinking provides context, not certainty, allowing a disciplined stacking strategy that aligns with risk tolerance. First, the US dollar index, DXY. A rising dollar usually exerts downward pressure on precious metals, but we've seen temporary decoupling recently. Tracking the DXY's intraday moves alongside silver and gold helps reveal where the market is diverging from historical correlations. A spike in the DXY concurrent with elevated silver prices signals something structural, either demand outpacing mechanical expectations or inventory shifts at dealers and refineries. Next, Treasury yields, particularly 2-year and 10-year notes. When yields rise, opportunity costs for holding non-interest-bearing metals increase. Confirmed data from the Treasury show a 10-year yield jump of 0.2% over 3 days last week. Observing how these yield movements align with bullion transactions helps anticipate short-term flows without making forecasts about ultimate price direction. Volume and open interest in COMEX and LBMA contracts are critical. Higher than average trading volumes paired with rising open interest indicate that positions are building, real money entering the market, not just intraday flips. Historical data confirm that rapid rises in open interest often precede periods of consolidation or increased volatility in physical markets. Spot versus premium spreads at retail dealers are a subtle but important signal. If 1-ounce rounds sell above spot by $3 to $4 consistently, it reflects real scarcity. Conversely, compression of spreads suggests replenishment or reduced urgency. Verified inventory reports from bullion dealers show that generics are often depleted first, with graded coins lingering. Watching this ratio helps gauge which segments of the market are under pressure. Finally, inflation measures tied to commodities such as CPI or PCE and energy prices like Brent crude. Confirmed data: Brent traded $83 to $90 recently, influencing both expectations for metals and dollar flows. Inflation expectations shape hedging behavior in real time, even before central banks respond. I track these indicators daily, noting divergences, correlations, and sudden shifts. None provide certainty, but each tells part of the story. Liquidity, demand, relative scarcity, and macro context. Observing these together allows a structured, disciplined approach to precious metals stacking rather than reacting to headlines or social media chatter. So what does all this tell us? Markets move, prices swing, volatility feels loud, but it's just the machinery adjusting. Inventory, demand, currency flows, and macro factors interacting. Your role isn't to predict the next $5 jump or fear the headlines. It's to observe, measure, and act according to structure and plan. Stacking, buying, holding. These aren't about timing perfection. They're about discipline over emotion. The data confirm that supply-demand dynamics, central bank activity, and refined inventory shifts drive the swings more than rumor or panic. Watch the indicators we discussed, note divergences, and stay aware of patterns, not predictions. This isn't investment advice. It's how I'm reading the market right now. Stay patient, manage risk, think in decades, not minutes. And remember, in precious metals, the story beneath the numbers is far more important than the numbers themselves.